Assalamu alaikum. I am Yusef Yakubi, Universitas Erlangga, Oner, Indonesia. I am very happy to be here and participate in this prestigious conference. And on the behalf of my co-authors, I wish to present a paper entitled The Impact of Digital Technology and Business Regulations on Financial Inclusion and Socio-Economic Developments in Low-Income Countries. Digital technology and business regulations are considered as stimulators of financial inclusion and socio-economic development. Digital technology has brought tremendous facilities that transformed almost every aspect of our life. There are many international players that speak increasingly about the benefits of digital technology and the importance of its facilities in our life. Online transactions, the online banking, they support communication speed, and they are also accountable and trustworthy. Similarly, business regulations formulate uh, market conditions, they support structural change, they shape the financial services which contribute to the whole financial systems, they elevate investment, protect also investors, they provide regulating reforms that help business as a whole. Financial inclusion is one of the most powerful tools that enhance socio-economic development. It contributes to the GDP and help also access and to financial services. Financial inclusion is referred as the ability of individuals as well as businesses to have full access to the financial services and products that meet their needs at an affordable cost. So the purpose of this paper is to investigate the impact of digital technology and business regulations on financial inclusion and socio-economic development in low-income countries. And the specific objectives is to estimate the effect of digital technology on access and usage and socio-economic development, as well as the effect of business regulations on quality and usage and socio-economic development. The second objective is to test the effect of access and usage and quality on socio-economic development. Please note that access, usage, and quality are components of financial inclusions, and here their impact on socio-economic development is tested. So the question of this study is actually, does the adoption of digital technology and business regulations spur financial inclusion and socio-economic developments in low-income countries? To answer this research question, the following conceptual framework has been designed, and these are the hypotheses that were formulated. As we can see in the diagram, there are 6 latent variables. 2 of them are the exogenous, the independent, that influence the other 4 variables. The 2 exogenous variables are digital technology and business regulations, while the other endogenous dependent variables are access, usage, and quality, and socio-economic development. This study posits that digital technology has direct impact on access, usage, and socio-economic development. The study also posits that business regulations affect directly quality, usage, and socio-economic development. Furthermore, the study postulates that the 3 components of financial inclusion, that are access, usage, and quality, have direct impact on socio-economic development. Here are the hypotheses that were formed. There are 11 hypotheses. And here are all the 6 latent variables represented by 21st observed indicators. The study utilizes a causal research approach and employs structural equation modeling. statistical techniques that use it's a multivariate statistical techniques that was found optimal to run the relationship between latent variables and observed variables in the study. The population of this study consists of 77 low and lower middle income countries, and the data used cross-sectional data based chiefly on secondary data that were collected from different resources, including the World Bank, UNDP, IMF, and Global Findex. For data analysis, Smart PLS3 software package were used. It was convenient throughout the relationship between latent and observed, as well as latent, as well as path coefficients. The model assessment consists of two stakes: measurement and structural. We start measurement level, that is actually measuring the outer model, and then structural, that's related to the inner model. So we started the measurement model assessment by checking the reliability of the items, and we can see all items almost surpass the value of 0.70, except B4, which actually reached the minimum level and but yet found significant and contribute to its construct. The validity and reliability of constructs were also tested here using the AVA, the average variance extracted. As we can see, the AVA that's in blue color exceeds 0.5 for all 6 constructs. Similarly, composite reliability as well as complex alpha values exceeded almost 0.7 for all constructs. Discriminant validity was also attempted in the study using Forney-Larkin criterion and HTMT, and all constructs were found distinct from each other. After running the measurement model assessment, we moved the structural model assessment, and we checked for the collinearity, making sure that the VIF, that's the variance inflation factors, does not exceed the value of 5. And we run also the R-square values. We can find also, as a rule of thumb, the R-square values is actually the 75% is considered substantial, 50% is considered moderate, and 25% is considered weak. On average, all endogenous variables in this study found at moderate level of R-square. Then, based on the threshold of the t-value for hypothesis testing, it's worth noting that most hypotheses in this study were supported. That means about 8 hypotheses were found significant, while 3 were not supported. You can see them in details here. The fairest sets of hypotheses, that's from hypothesis 1 to hypothesis 6, that were related to the digital technology and business regulations, were found all significant. And we can see here digital technology affects significantly access, usage, and socioeconomic development. As we can see, the p-value is less than 0.01 and less than also 0.05. Similarly, business regulations affects quality, usage, and socioeconomic development significantly. Regarding the impact of financial inclusion on socioeconomic development, that are hypotheses 7, 8, and 9, we found only access that has a significant impact on socioeconomic development, as the p-value is less than 0.5. Usage and quality do not affect socioeconomic development in this study. Regarding the relationship between financial inclusion components, we can find also that usage affects significantly access, while access does not affect quality. The findings of this study are considered important because actually it is believed that both digital technology and business regulations combined have the power to solve key global challenges and also improve the social participation and enhance the economic development in low-income countries. Low-income countries are confronted by several social and economic problems, including gender inequality, adversity, low outreach, low accessibility, financial exclusion. They are also poor economies. They face similar obstacles, and actually they have a GNI, gross national income per capita, of only 1,000.0025 or even less. Despite that, they actually represent the majority of the world nations. So this study casts a very important socio-economic theme and that are related to low-income countries. Regarding the originality of the study, to the best of our knowledge, this is the first study that present the combine both digital technology and business regulations as stimulators of socio-economic development. The study also presents its financial inclusion as a means that influence and being influenced also. It also presents all the components of the financial inclusion. Some implications that this study proposes includes that fintech companies, banks, and other financial institutions need to post digital financial services, which seems cost-effective, efficient, and can easily reach the impact population in urban and rural areas compared to the traditional financial methods. Governments, local leaders, as well as the regulators also can work on developing regulatory reforms that could help also the ease of doing business and frame legal forms that protect investors and enhance business. International players, donors, and other organizations also have to keep on planning programs and intervention to support digital technology and business regulations. There are a lot of limitations in the study. One of them is the homogeneity assumption. This study assumes that low-income countries are homogeneous. Low-income countries may share similar elements or even identical features. However, they may also have different categories, different different morals and beliefs. Another limitation is also the number of the observed indicators are considered relatively small here due to the unavailability of the complete data. Findings of the study may also can be compared and contrasted with the findings from with the high and middle income countries. That's all. Thank you so much, and I'm very happy to hear any questions or remarks.